Speaking of bucking tradition, as we talked about a little earlier, there was an article on Bloomberg that said there are some financial planning rules that, well, people need to give up on. The list includes the 60-40 portfolio mix of stocks to bonds. The article said that you should have 2 to 5 years of expenses in fixed income so you don't have to sell stocks in a down market, thereby, compounding those losses. And they go on to say the rest of your money should actually be in stocks. What are your thoughts on this methodology? Do you agree with it?
I really agree that is, area to take a look at. And I think that's an area that most investors are really not paying attention to. So again, if we look at a 60-40 portfolio mix of stocks to bonds, what that philosophy was is you put a certain amount of money in stocks and then a certain amount of money in bonds. In this example, 60% stocks, 40% bonds. So as an investor got older and closer to retirement time, what happens is the allocation may change, meaning that the stock percentage may come down, the bond percentage would go up. Bonds are generally perceived to be less risky than stocks. Here's where in this environment today, where it's a challenge. First of all, you have an environment that both stocks and bonds are going down. Now, at some point in the future, the markets will correct themselves, or in a couple of years from now, things might work and 60-40 might be something to revisit. But right now what you have is you have interest rate risk with bonds. As interest rates go up, we're seeing bond prices for the most part go down. And then the stock markets become under pressure because of the uncertainty with inflation, the markets, the economy. It puts a retiree in a tough spot because it's like a 1-2 punch. Not only are they getting punched in the mouth from the stock market going down, they're getting punched in the gut when the bond market goes down. So in this article, they state that you should have 2 to 5 years worth of expenses in fixed income. And I'm going to rephrase that. I'm going to say fixed investments, things that are traditionally principally protected not to go down. Those could be things like FDIC insured bank CDs. They could be money market accounts. They could be things like fixed or an index annuity. There are different examples of products that are out there that are fixed, and these are investments that are protected against market decline. By having that, what is going to do is it's going to put you in a position that you don't have to sell in a down market. It's really, again, it's a big part of the core philosophy behind our trademark system called the independent income system, which is to create those buckets of money that are designed to protect you. So if you feel like you're in the traditional 60-40 approach, the independent income system can be a new way to look at your money. In fact, those of you that are listening, if you're in like a target date account, that would be a type of portfolio that has some of the 60-40, 80-20 type portfolio mix that's out there. There can be some other ways to take a look at it. That way you don't have all of your money at risk. The other thing that I liked is, in the past, I served in the Marine Corps. So in the Marine Corps, they always taught you to have a plan B in place. For quite a few years, Jeremy, the stock market was doing great. The market was up a lot. And it would always be okay, I think, in many situations for a retiree where they could sell off some of their profits while the market is higher to get their monthly income needs. In fact, a retiree might even have the opportunity to sell off profits and put more money aside in another year or two to build up that protected or safe income that they need if and when the market turns down. And the plan B is great because now in environments like this where equities are down, what the investor can do is they can switch over and they can then start to take income off of those investments that were not subject to market declines. Again, there's pros and cons to anything that you do. So whether you're in a bank CD or an annuity, you have to pay attention to things like, surrender charges and liquidity and become familiar with how your products work. But I think that's where somebody that's, specializes and focuses on retirement planning can help you maybe take a look at a different approach. What are your thoughts, Jeremy?
I think the 60-40 approach, I like to use rules of thumb as kind of a guide. There's another rule of thumb that says your age should be in fixed income. I also, when you look at target date funds, it's kind of a set it and forget it type program, which I'm not necessarily a fan of. A lot of these are, I would even equate index funds to be like that. So an index fund, if my thoughts would be, if I know that if I have a bucket of stocks, say 500, if we took a look at the S&P 500, And I knew some of those were not good companies, they're not good buys, they're not something that I want to own. Why would I own all 500 when I could, take a look at something that through some proper research, why would I buy all the dogs or the bad stocks just to be diversified or subscribing to a rule of thumb or a set it and forget it type portfolio? I do like the 60-40, or what this article points out is having 2 to 5 years in fixed assets, and I do agree that does look at a bunch of different asset classes, not only bonds but also CDs. We talk about government I bonds recently. So my thoughts on the 60-40 are, it's again a rule of thumb, and as you get closer to retirement, you probably want to have a little bit more in the bond bucket or the safe and protected bucket. But as Chris mentioned earlier, there is no cookie cutter approach. Each individual situation is different, and I would encourage anyone listening to, talk to somebody about your own specific situation to see if the 60-40 is the right mix for you.
It's not to say that if you have that 60-40 mindset or if you're in a target date fund, you're doing it wrong. It's just kind of been the conventional wisdom. And obviously that's better than nothing when it comes to retirement planning. You're still saving money away. But as bonds have really taken a beating this year, the flaw of that 60-40 portfolio, the flaws of the target date fund are really kind of showing themselves. And there could potentially be a better way for you as you get closer and closer to retirement to see what those options are. Again, America's Retirement Headquarters is here for you. All you have to do is go to the website, americasretirementheadquarters.com, or give a call, 419-794-3030. I'll be happy to schedule you in, start developing that retirement strategy to get you to, through, and beyond retirement. 419-794-3030.